Hello and welcome to Las Vegas to the 6th edition of the Infrastructure Summit by Structure Research. Joining me now on the sidelines of the event is Craig Scroggie, CEO of NEXTDC. And Craig, pleasure speaking to you. It's been long overdue, actually, for us to chat on camera. How's the event treating you? How's Vegas treating you?
Yeah, this event's fantastic. Yeah. One of the things that really makes this a unique opportunity, it's quite a small, focused, but very, very deep event on the infrastructure side. So there's a lot of big global conferences, but this one's highly focused, so I really enjoy coming here.
Yeah, I think you just see it now because we've seen a surge in trade shows, and this one really stands out more just for the connection, the networking side of it. But look, the theme of this year's conference is concurrence. And this comes into the play of so many things happening at the same time in the industry. AI demand, supply chain constraints, policy regulation, energy, you name it, we're going through something. Yeah. In your view, what trends are going to shape the growth of data centers and digital infrastructure as a whole, but the growth of the data center space in the next 12 months, 16, 18 months? What do you think within this concurrence age is going to be the real key driver for development?
If you start at the macro level and think that we are in the beginning of the fourth industrial revolution. So if you go sort of back in time, steam, electricity, the internet, this fourth industrial revolution will drive more change than probably any other time in history. But like all the other industrial revolutions, it will be defined by access to energy. And the really big change we're going through, obviously, is the transition from linear computing to GPUs. So we get that parallel computing, is that it's an order of magnitude shift in the scale of the size of data centers, the speed that they need to be built in order to support the foundational model builders. Those large language models are going to drive more change in the next few years than we've seen in the last decade.
Yeah, no, 100%, and the change is going to be magnanimous when even compared to the fourth industrial revolution, because this is going to change the game completely. It's going to change society as a whole, even more so than back then. But looking into the development of data centers, of course, energy is a huge part of it. This is an energy business, but it used to be a real estate business. 6 years ago, it was most of a real estate business, and now it is an energy business. When you look into locations for data centers, how is AI changing the prioritization of site location? How do you choose where to go? Because a lot of people give the answer it's driven by customers, but this is becoming such a big thing now that the customer might want something, but maybe there's not enough land, maybe there's not enough energy there. We have to go some further out, closer to a big dam, closer to Canada, for example, where they have a lot of hydropower. How is AI changing site location allocation?
I think you have to start with what is the problem that's being solved. The last decade of computing has not gone away. So hyperscale data centers for corporate cloud, they're still critically important. Metropolitan data centers, the shutting down of legacy on-premise data center infrastructure to get better sustainability outcomes, get access to cloud on-ramps. Metro data centers are still going to play a very important role in the landscape. And then the edge data centers that support cable landing stations, satellite telemetry systems, they're important as well. So those three elements, hyperscale cloud, metropolitan data centers, and the edge, they're not going away. They're continuing to grow. But the big change is an entirely new industry is being born in real time. So the the emergence of neo clouds combined with hyperscalers supporting GPU as a service means that we've got a whole new industry and an entirely new generation of technology and data center infrastructure being designed in real time. The one key difference in this is in the past we used to build a data center and bring the power to it, and now, given the sheer scale of data centers going from 10 megawatts to 100 megawatts and now to 1,000 megawatts, in a lot of cases, we're having to take the data center to the power.
When it comes to the actual build of the data center, we're seeing hyperscalers building a lot on their side, but how is this going to shift in the next 24 months, for example? Are we going to see more self-builds? Are we going to see them leasing more from colocation operators? Or are we really just going to go for a hybrid model where they get some on their side, they get some on our side? How do you see that changing, the model changing? And then how does it impact capital allocation as well?
I think the first question is how much capital and how you allocate it.
And speeds? Would you add speed into that?
Sure, but the critical issue is that if you're a big global operator of hyperscale data centers, you've been building some of your own, you've been using colo to enter new markets, and you've had a hybrid. But today, if you're a neo cloud and you didn't exist 2 or 3 years ago, the sheer scale of capital required, we're not talking 100 million or a billion. We're talking 10 or 20 or 50 billion. And every dollar counts. And if you're a new company that doesn't have a credit rating or a history, every dollar that you can get access to, whether that's a dollar from equity or a dollar from debt secured against the GPUs that you're buying, capital efficiency is going to be one of the most important decisions that you make in terms of how you really are geared for growth.
Yeah, and this market is super active on the capital front. I mean, from acquisitions to backing to financing. We just had this huge acquisition this week of $40 billion as well. When you're looking to capital structures in the data center space, are investors backing, are they going more for the fast expansion, for the rapid development of facilities, or is capital allocation becoming stricter? And are they asking more questions? Is it becoming stricter in the management of how they enter the game?
At the end of the day, it doesn't really matter what the business is. Everything is about the pricing of risk. So the term of the contract and the quality of the counterparty is going to define the cost of capital. So one of the key issues really that the industry is going through is that there is trillions of dollars going to be allocated to the growth of artificial intelligence over the next decade. Trillions. And so therefore, as you start to tap into those funds, some people will accept higher rates of risk for a higher rate of return, and others will want very low risk and expect lower rates of return given the risk profile. So I think it really depends on a balanced portfolio of capital allocation, and you'll see whether it's big global sovereign wealth funds, private debt providers, they'll build blended portfolios where they take high risk and high return, and they balance that against low risk and more moderate returns.
Okay, just to pick up your brains quickly, because it's valuations, that's all changing as well. How would you see the valuation game changing? The multiples are crazy at the moment again. We thought at some point they were going to start coming down, but they don't seem to be coming down. We had the AirTrunk acquisition last year, 24 billion Australian dollars. We've got a line this week, 40 billion US dollars. What's your take on valuations, multiples? Where are we going with this?
Look, at the end of the day, you can only control the things that you can control. So you build a great company, you get long-term quality credit counterparties, you sign billions in business, and the market will decide, the market will ultimately price what your business is worth. So I think right now, we're seeing record capital inflows and investment in digital infrastructure. It is, go back in history, the roads, rail and port of the digital era. So I have no question that we will see those trillions flow. If you look at Sam Altman's estimate of saying, 30 gigawatts, maybe not enough. The number's probably 250 gigawatts. Even if that's half right, we will see trillions invested in digital infrastructure. The type of problems that we can solve in medicine and science, look at Google's breakthroughs with DeepMind in protein folding. As a result of GPUs and NVIDIA's role in the production of intelligence, I don't have any doubt in my mind that this will be the single most important moment in history. I think we're just privileged to be here right now.
I guess there's another big buzzword going around, two buzzwords, AI bubble. Bubble or not?
Very simple. If you read Azim Asmar's white paper, he graded a really great piece of detail on whether AI is a bubble, given it's one of the big questions that have been asked of recent time. His opinion is no. I would suggest you read the white paper. Sam Altman was quoted as having saying, two things can be simultaneously true. There can be a bubble in any technology, but it can also be the single most value-creating moment in history. I don't have any doubt in my mind, after having spent 30 years in technology, that this is a unique moment. I think we're incredibly privileged to be here building digital infrastructure that will change the shape of the world, not in just decades to come, but literally in the next sort of 5 to 10 years, there will be more change driven by technology than we've ever seen in history.
It's like you said before, there's a whole new industry being born right before our eyes, and the impact on society is going to be tremendous. I'm very excited to see what's going to come out of it. But let's talk quickly about NEXTDC and Asia. What's your plans? How's the business changing on the back of everything we just discussed? So AI, capital allocations, and let's bring some policy, geopolitics into it as well.
Sure.
How's the business navigating the world right now? And then we'll talk where you're going to go next.
Start with the company. So today, we have a larger backlog of signed customer contracts than we are billing today. So just in the next 2 years, the company will more than double in size, delivering everything that we've already sold.
And how many megawatts or gigawatts would that be?
So today, 300. We're heading over 5, 6, 700. 16 operational data centers in Australia, another 10 under construction. We're building in Kuala Lumpur in Malaysia, and Tokyo in Japan. So yeah, the region, you add up the size of the population in the Southeast Asian economy, it's bigger than the whole Americas. So the single fastest growing market or theatre in the world is the Asia region. So it's a great place to be building digital infrastructure. They'll skip entire generations of technology. The two key issues, really, the regulatory landscape. We're living in a more challenging geopolitical environment than we have at any other point in time in history. We've got the US versus China. Dan Wang wrote a great book just recently called Breakneck about the battle between the US and China for AI supremacy, and it's a great read if you want some context, not just to the history, but what the future may look like between the US and China, the control of chips, export bans, what that's doing for the rest of growth in Asia. And then you've got local legislative landscape issues, text and data mining, copyright reform, fair use carve-outs. So I look at the Australian opportunity and that for Asia. Australia was defined by mining 1.0. Its history has been digging up natural resources and shipping them around the world. Mining 2.0, being able to use solar and wind and battery technology and produce large-scale knowledge by manufacturing of intelligence and then exporting that. Mining 2.0 is the future of Australia's economy. And I think it's one of the biggest opportunities that we will see in the world today.
Okay, so you're going to be very, very busy. And I'll ask you about the book a bit more after we come off camera. But capital structure. Talk us through very quickly through the capital structure of NEXTDC. How you're funding? Are you going to be looking for more capital, debt, equity? What is the plan on that front?
I think everybody in the digital infrastructure landscape needs more capital. So, we're a public listed company. We're an ASX top 100 organisation. We're over 10 billion market cap. We just did about 6.5 billion in debt. Most of that's allocated. We're raising another 15 billion for our next 1 gigawatt development opportunity in Sydney. Our run rate capex is about 2 billion a year, and that'll continue to scale. So, as long as you've got supporter customers, great tenor in your contracts, good quality counterparties, I think access to capital is not the issue to solve. Speed and scale development of data center infrastructure is really how you take advantage of this opportunity.
Okay, last question. What country are you going to go into that you're not operating yet?
Thailand.
Okay, this is going to be your next destination. Greg Scroggie, CEO of NEXTDC, thanks so much for talking to me.
Thanks, man.
As for your home, thank you for watching, and do check our website and social media for the latest digital infrastructure news from across the globe. At the Tech Capital, you lead, we report. Bye for now.